The limitations of GDP as a measure of economic progress. Gross domestic product (GDP) is one of the most widely used indicators to measure a country's economic performance. It represents the total value of goods and services produced within a country in a specific period. While GDP is a useful tool for understanding economic activity, relying on it as the sole indicator of progress has significant limitations. Here's why. 1. Ignores income inequality. GDP measures the total output of an economy but does not account for how income is distributed among the population. A country may have a high GDP, but if wealth is concentrated in the hands of a few, the majority of people may still live in poverty. For example, a nation with a booming tech industry might show impressive GDP growth, but if the benefits are not shared widely, it doesn't reflect true progress. 2. Overlooks non-market activities. GDP only counts market transactions such as goods and services sold for money. It ignores unpaid work like household chores, caregiving, or volunteer activities which are vital for societal well-being. For instance, a parent staying home to care for children contributes to society but isn't reflected in GDP calculations. 3. Neglects environmental costs. GDP growth often comes at the expense of the environment. Activities like deforestation, pollution, and over-extraction of resources boost GDP but harm the planet. For example, a factory producing goods increases GDP, but if it pollutes rivers and air, the long-term damage to health and ecosystems isn't subtracted from GDP figures. 4. Fails to measure quality of life. GDP doesn't capture factors that contribute to people's well-being such as health, education, leisure, and safety. A country with high GDP might still have poor healthcare, low literacy rates, or high crime levels. For instance, a nation focused on industrial growth might neglect public services, leaving its citizens with a lower quality of life. 5. Doesn't account for sustainability. GDP measures current economic activity but doesn't consider whether this growth is sustainable. For example, overfishing might boost GDP today, but it depletes fish stocks for future generations. Similarly, excessive use of non-renewable resources may lead to economic collapse once those resources run out. 6. Excludes the informal economy. In many developing countries, a large portion of economic activity occurs in the informal sector, such as street vendors or small-scale farmers. These activities often go unrecorded, leading to an underestimation of actual economic progress. 7. Encourages short-term thinking. Policymakers often focus on boosting GDP to show progress, even if it means neglecting long-term goals. For example, cutting down forests for timber increases GDP in the short term but harms biodiversity and climate stability in the long run. In conclusion, while GDP is a useful tool for measuring economic activity, it is not a comprehensive indicator of progress. To get a fuller picture of a nation's well-being, we need to consider other metrics like the Human Development Index (HDI), Genuine Progress Indicator (GPI), or Environmental Performance Index (EPI). These measures account for factors like inequality, environmental health, and quality of life, providing a more balanced view of progress. Relying solely on GDP can lead to misguided policies that prioritize economic growth over sustainable and inclusive development.